Welcome and thank you for joining our discussion on 2017 year-end planning for investors. Our agenda is straightforward. First, we'll begin with some interesting facts, then we'll look at a quick equity market update. We will conclude with a discussion on some of the year-end tax planning and strategies you can consider. Before we begin, it is always important to review that there are 5 key areas of financial planning: protection, retirement plan, investments, tax planning, and estate planning. As your comprehensive financial planning firm, we try to always consider the impact of any recommendation we make on not just one, but all of these areas for our clients. We will be focusing primarily on the economy's outlook, which could have an impact on some of your financial planning decisions. Year-end planning is helpful. Taking the time now to assess your financial situation and discuss potential year-end financial strategies with us can help reaffirm your overall financial plans. It is helpful to review your estate plan, retirement and investment plans, and tax plan. You can then see if your time horizons and risk tolerance is still aligned with your goals. This year has been a year for record making on Wall Street. Here are just a few records that have been set. The Dow Jones Industrial Average has set over 50 new record closing highs since the 2016 presidential election. The Dow Jones Industrial Average has closed over 22,000 in both August and September of this year. The Dow Jones Industrial Average had 2 streaks lasting more than 10 days so far this year. The last time this happened was in 1959. Currently, there is a lot of talk about tax reform. Here's what has primarily been released. On a broad base, we've seen one-page tax reform, and it includes 225 words, 7 numbers. Tax rules go from too complicated to oversimplified, and it's missing specific details. The latest version of tax reform was released on September 27th. It was 9 pages and lacked many details. The key points of this proposal include: first, simplifying the current 7 individual tax brackets into 3 brackets of 12, 25, and 35%. A larger standard deduction. The standard deduction for all taxes would be doubled to $12,000 for individuals, up from $6,350, and $24,000 for married couples, up from $12,700. The elimination of most itemized deductions. While not specifically named, the only deduction preserved in the plan explicitly are for charitable gifts and home mortgage interest. An increase in the size of the child tax credit. The plan proposes to make the first $1,000 of the child tax credit refundable and would increase the income level at which the credit would phase out. The elimination of the alternative minimum tax. The elimination of the estate tax. A corporate tax rate of 20%. This would bring the current 35% statutory federal rate down significantly. And a one-time repatriation tax, where all overseas assets from U.S.-owned companies will be considered repatriated and taxed at a one-time lower rate. This is designed to encourage corporate profits back from overseas. We will continue to monitor the progress of the proposed tax reform and how changes may affect our clients. A main area of focus we are watching is interest rates. As you know, short-term rates have been steadily on the rise. The Federal Reserve raised the federal funds rate range during their June meeting to 1% to 1.25%. Following that session, Federal Reserve Chair Janet Yellen stated at a press conference, "It reflects the progress the economy has made." Current forecasts call for one more slight rate hike in 2017 and more in 2018. So will they happen? No one knows for sure, but there is some speculation that the Fed will not raise the range again this year. As long as the economy continues to grow, they have forecast that there will be a 3/4 point rate increase in both 2018 and 2019. If this occurs, the Fed's preferred level of 3% will be met by the 3rd rate hike in 2019. A key factor the Feds are watching for is any inflationary effects if Trump's proposed tax cuts are passed through Congress and the overall state of the economy. Although interest rates are still low, with interest rates on the rise, we are reviewing your interest rate sensitive investments. This includes that we, 1, make sure you are comfortable with your time horizons and assess your risk tolerance. Are your investments compatible with both? As advisors, we help our clients review the income-producing investments they own. Our primary goal is to match your portfolio to your timeliness and personal financial situation. 2, maintain complete liquidity for all short-term and near-term needs. Liquid accounts in today's interest rate environment will probably not keep pace with inflation. Although it is always important to maintain a liquid component in your portfolio, you should think about what major expenses you will incur in the next 2 years and consider keeping a larger than typical liquid pool of assets. 3, review your bond holdings duration. In bond investing, we talk about duration as a measure of a bond's sensitivity to interest rate changes. The longer the duration, the more a bond's price is impacted by interest rate changes. Typically, bonds with longer maturities have longer duration and vice versa. So investing in bonds with lower duration or shorter maturities can help to reduce your exposure to rising interest rates. 4. Considering shorter terms over high yields. Although shorter-term bond yields less than longer-term bonds, they typically lose less value when rates rise. A good focus is on bonds maturing in 2 to 3 years or less. And number 5, diversify. We can potentially limit your risk, and we can help provide your portfolio stability during fluctuating markets that can bring variability into your investment returns. Now let's discuss year-end tax planning. What is critical to tax planning today is to determine your tax bracket. For illustrative purposes, we have grouped tax brackets into 3 major categories. While the goal is to always be tax efficient, it is easier for those in the 10 or 15% tax brackets. Many of you are in the 15 or 28% tax bracket and should always be tax aware. And then many of you are also in the highest, or 33, 35, and 39.6% tax bracket, and those clients need to be what we refer to as most tax sensitive. Regardless of your tax bracket, your goal should always be to minimize taxes whenever possible. Here's a quick look at 2017's federal income tax rates and brackets. Here are several opportunities that we may be able to plan for. Tax planning. Defer recognition of income to capture lower rates in the future. Accelerate the recognition of losses to capture higher rates now. Plan in general for different rates in the future, such as if considering a Roth conversion. And in estate planning, defer technique, which incur income, gift, or estate tax. Consider gifting strategies. We would like to focus on these 3 key planning opportunities: tax harvesting, gains and losses, retirement plan funding, and gifting. Let's start with harvesting gains and losses. Gain harvesting, what are the trade-offs? On the surface, it appears that taxpayers should always harvest gains. However, harvesting gains introduces a trade-off between lower rates versus the loss of tax deferral. When we harvest a gain, tax is paid at a lower rate, but it is paid sooner. So we determine a crossover point at which selling sooner makes more sense. How do you use gain harvesting? Ideally, we try to sell assets with long-term capital gains in 2017 if able to take advantage of lower brackets. We can repurchase the same or similar assets. As an investor, a good rule is to always think about selling assets whenever you would have sold them otherwise. Gain harvesting. When should gains be harvested? For those with a very short-term time horizon, gain harvesting will almost always be favorable because the benefit of tax deferral is small. For those with a very long time horizon, gain harvesting will almost always be unfavorable because of the benefit of tax deferral is large. And for taxpayers in the 0% long-term capital gains bracket in 2017, gain harvesting will always be favorable from a tax perspective because it gives you a free basis step up. Here are loss harvesting strategies. Sell and buy stock of similar company. For example, when a taxpayer has a stock, for example, Coke, with an unrealized loss, example, a loss stock. Or 2, taxpayers purchase a similar stock, Pepsi, at any time prior to or after the sale of the loss stock. Note that the sale and purchase can occur on the same day and that the 2 stocks are not substantially identical. We can also double up loss stock and then wait 31 days. Now let's look at funding your retirement. Always consider contributing to your retirement plan if possible. Due to the power of compounding, tax-deferred retirement accounts are an optimal strategy to grow your wealth. If your company matches a portion of your 401k contributions, then even better. Make sure that you contribute the maximum amount each year to your 401k. In 2017, you can still contribute $18,000. The overall contribution limit has increased by $1,000 to $54,000, including the employer contributions. At a minimum, try to contribute as much as you can to qualify for an employer match. And if you haven't already done so, consider a Roth IRA. Let's talk a little bit about Roth IRAs. There are 2 major components to review: Roth IRA contributions and Roth IRA conversions. For married couples whose modified adjusted gross incomes are above $196,000 and single filers with modified adjusted gross incomes above $133,000, you cannot contribute to a Roth in 2017. However, anyone, regardless of their income, can convert from a traditional IRA to a Roth IRA. Let's focus on Roth IRA conversions and their benefits. A Roth IRA conversion lowers overall taxable income long term. You benefit from tax-free compounding. Roth IRAs have no required minimum distributions at age 70 and a half, and there are tax-free withdrawals for beneficiaries. Note, Roth tax rules can be complicated, and conversions certainly require holding periods to avoid potential penalties. There are critical decision factors that need to be considered. What will be your tax rate differential? For example, your tax rate in the year of the conversion versus tax rate in years of withdrawals. Do you have the ability to use outside assets, for example, non-IRA funds, to pay the income tax on the conversion? Is there a time horizon or need for the IRA to meet annual living expenses? In converting a traditional IRA to a Roth IRA, you will need to calculate how much you owe in ordinary income tax on the amounts converted. A conversion may place you in a higher tax bracket than you are in now. Please keep in mind that Roth IRA conversions may not be appropriate for all investors, and individual situations may vary. We suggest that you discuss tax issues with a qualified tax advisor. A goal of a successful Roth IRA conversion is to keep as much of the conversion income as possible in lower income tax brackets. Many gifting options are available this year. The annual gift amount for 2017 remains the same at $14,000 per person. 529 plans are also available, and they can allow higher gift amounts. You can front-load contributions to a 529 plan by donating $70,000 in 1 year and spreading the gift over the next 5 years so that you're gifting $14,000 per year. Charitable donations for 2017 need to be made in 2017. Donating RMDs when over age 70 and a half should be viewed first before any other gifts. Always be aware of lifetime gifting amounts. The 2017 gift tax exemption is $5.49 million per individual, up from $5.45 million in 2016. There are many gifting options available. We can discuss this with you and your accountant to determine the correct strategy for you. So where do we go from here? One of our main focuses as your financial advisors is to continuously review and evaluate changes for you on an ongoing basis. What can you expect from us? You can expect constant communication, frequent discussions, and you can expect that we are continually reviewing economic, tax, estate, and investment issues for our clients. As you know, our role as your advisor is to maintain a non-emotional, objective, avoid knee-jerk reactions, assist you in making decisions that are always in your best interest, and we will be here for you. Once again, before year-end, we will be sending out our 2017 year-end tax reports. If you are not on our mailing list, please sign up so that we can make sure you get a copy. And most importantly, thank you. We appreciate the opportunity to assist you with your financial needs.